If you woke up this morning, grabbed your phone, and saw a sea of red across your portfolio, if you watched 10% or 15% of your net worth evaporate overnight, and if you felt that tightness in your chest, worrying that Bitcoin is losing momentum, or even asking yourself if this bull run is officially over, then this video is exactly for you. We are not here to read surface-level headlines like the mainstream media. Here, we work with data, we dissect the macro, we get inside the brain of smart money to understand why they are making these moves. In this special deep dive, I'm breaking down the 5 core factors currently strangling the market, 5 vices tightening around Bitcoin's price. From the ETF exodus and the nightmare scenario of the Japanese yen carry trade to the global regulatory landscape. But most importantly, I'm going to answer the biggest question of all. Is this the end? Or is this the start of the great wealth transfer? This is the time for cool heads. Take a deep breath. Let's get into it. First, let's address the elephant in the room that we cannot ignore this morning. Bitcoin ETF outflows are bleeding out. Remember the glory days a few weeks ago when BlackRock and Fidelity were scooping up hundreds of millions of dollars daily? We called them our saviors, the bottomless whales. But financial markets don't run on feelings, they run on risk and reward. The last 12 hours tell a completely different story. On-chain data confirms we just witnessed a massive withdrawal session. Total outflows hit hundreds of millions. This is the highest level we've seen in over 2 weeks. Why is this critical enough to be my point number 1? You need to understand the nature of ETFs. They are Wall Street's capital valve into this market. The people holding these ETFs are not diamond hands who believe in decentralization like you and me. They are fund managers. They are institutions. When they see macro risk spiking, they don't hodl. They execute a maneuver called risk off. This aggressive outflow signals 2 dangerous things for the short term. 1, capital flight to safety. Money is leaving Bitcoin and moving into cash or short-term T-bills. They are accepting lower yields to preserve capital. 2, weakening demand. As ETFs stop buying and switch to net selling, we lose the shield defending key support levels. Technically, massive outflows like this reinforce a market structure I call sideways bias down. This means the market will grind sideways, but with constant selling pressure, dragging prices lower and eroding the patience of retail investors. Smart money is rebalancing. They are waiting. And trust me, when smart money waits, the market usually has to go lower to find liquidity. Now, let's talk about the black swan lurking in the shadows. This is the macro analysis few people are watching, but it impacts your wallet directly, perhaps even more than the ETF news. It is the Bank of Japan. You might be asking, I live in the US, I invest in global crypto, why should I care about interest rates on an island in East Asia? The answer lies in 3 words that make every macro investor shudder. Unwind yen carry trade. Let me explain it simply. For years, Japan maintained ultra-low interest rates, near zero or even negative. This turned the Japanese yen into the world's cheapest funding source. What did hedge funds do? They borrowed billions, even trillions of yen at 0% interest, then converted that yen into USD to invest in higher yielding, higher risk assets, including US tech stocks and, of course, Bitcoin. That is the massive leverage propping up global financial markets. But in the last 12 hours, the Bank of Japan sent a strictly hawkish signal. They are threatening to tighten monetary policy, potentially hiking rates to save the yen. What happens when yen interest rates rise? The cost of borrowing spikes. The borrow cheap, invest dear scheme collapses. These funds are forced to do one thing: sell risk assets to pay back their yen debts. This is called deleveraging. When the carry trade is threatened, margin and futures liquidity is pulled immediately. It triggers a chain reaction. Fund A sells Bitcoin, so the price drops. Fund B gets a margin call, so Fund B sells, leading to the price dropping further. The risk of a cascade liquidation is extremely high. This selling pressure isn't coming because Bitcoin is broken or the network failed. It's coming because the era of cheap money is pausing. This is why we see sudden 10 to 20% drops with no specific bad crypto news. That is the invisible hand of macro choking the market. If Japan is the left jab, US macro is the right hook. We are caught in a pincer movement, creating a total risk-off sentiment. There is a narrative we often tell ourselves. Bitcoin is a safe haven. Bitcoin is digital gold. I hate to break it to you. In the short term, that narrative is shattered. Data from the last 12 hours shows that in the eyes of Wall Street right now, Bitcoin is trading exactly like a high beta tech asset. Look at the correlation chart between Bitcoin and the Nasdaq 100. They are moving in lockstep. When fears about the Federal Reserve rise, when inflation remains sticky, and the outlook for rate cuts blurs, what do investors do? They cut. Exposure to risk, they sell tech stocks, they sell mining stocks, and they sell Bitcoin. Why is Bitcoin sold first? Because it trades 24/7. When system liquidity contracts, when funds need cash fast for margin calls, Bitcoin is the easiest asset to sell to raise USD. It becomes the ATM for investors. This explains why price struggles to break out despite good news. The market currently has high bad news sensitivity. A small piece of bad news from the Fed can tank Bitcoin by 5%, but huge good news might only pump it by 1%. This is a classic sign of a weak market structure. It's like a sick patient. A light breeze is enough to knock them over. We've talked about sell pressure. What about buy pressure? Why haven't we seen new money saving the market? The answer lies with the G20 and what they call regulatory gaps. The G20's risk watchdog just issued a stern warning. The global crypto regulatory framework still has too many holes. They emphasized financial stability risks if capital continues to flow into this sector before laws catch up. You might think they're just fear-mongering. But for pension funds and insurance funds holding trillions of dollars, this warning is a do not enter sign. Why are big institutions still hesitant? Why is BlackRock just the beginning and not the flood? It is because of this uncertainty. They fear legal risk. They fear the SEC. They fear G20 sanctions. They only dare to enter via ETFs because that is a highly compliant product. They restrict direct flows into on-chain activities. The consequence? The market currently lacks a truly sustainable new capital wave. The volume we see daily is mostly player versus player, money circulating from one pocket to another, recycling old capital. We don't have enough fresh money to break hard resistance levels. Until the G20 and nations fill these gaps with clear laws, big money will remain hesitant, and without new inflows, the market is vulnerable to sell pressure from the old guard. If you've listened this far and feel like selling everything to run for the hills, wait, don't rush. Because the full picture isn't just gray. News piece number 5, and the most critical bright spot for the long term, is the key to decoding why this is the great wealth transfer. The U.S. is gradually pushing crypto into the commodity framework. Recent legislative efforts in Washington, despite the noise from the SEC, are quietly moving in a unified direction, classifying Bitcoin and mature blockchains as commodities under the oversight of the CFTC, not as securities under the SEC. This is maximum bullish for the long term. You have to understand the difference between a commodity and a security. Legitimacy. When Bitcoin is recognized as a commodity, it sits at the same table as gold, oil, wheat, and coffee. It is no longer magic internet money. It is a real asset. This creates a solid legal foundation for complex derivatives, for bank custody, and allows the most conservative capital to enter, escaping the SEC. The SEC has been a nightmare of endless lawsuits. The CFTC tends to be more pragmatic, focused on transparent derivatives markets. However, and there is always a however, we are in the transition phase. Transitions are never smooth, they are painful. In the short term, money only flows through standard channels like ETFs. Direct spot speculative capital isn't pumping hard because exchanges are still being scrutinized to purify them for commodity standards. This makes Bitcoin price action choppy. It won't go up in a straight line like 2017 or 2020. It grinds. We are on the bumpy gravel road before we hit the highway. So stringing these 5 puzzle pieces together, ETF dumping, Japan tightening, US risk off, G20 gaps, but a commodity future opening up. What is the panoramic view? We are taking a double whammy. Short-term macro is ugly. This suppresses price, creating a bearish short-term. Long-term structure is forming, building the foundation for the next massive bullish long-term cycle. Based on this data, I have to be honest with you, the market will likely continue sideways biased down for the next few days or even weeks. There will be no magic candle tomorrow. The psychological support at $85K and lower levels will be tested repeatedly. Your patience will be roasted on the fires of fear. But remember the Michael Saylor quote, volatility is the price you pay for performance. Why do you think ETFs are selling? Why is the Japan news hitting now? These drops caused by panic selling are the market's mechanism for wealth transfer. It transfers Bitcoin from weak hands, the over-leveraged, the fearful, the impatient, to the strong hands, those with cash on the sidelines, long-term vision, and an understanding of the commodity thesis. So, what is my strategy? If you are a short-term trader, be extremely careful with the Bank of Japan and yen carry trade. Do not try to catch a falling knife. Do not use high leverage right now because the risk of cascade liquidation is real. Protect your capital before thinking about profit. If you are a long-term investor, look at the U.S. legal commodity horizon. That is the destination. Drops to $85K or even lower are not the time to sell. They are a gift. I am closely monitoring sentiment. Currently, we are in fear, but we haven't hit capitulation yet. I will wait for confirmation signals from ETF inflows reversing before making aggressive moves. The crypto market is not for the faint of heart, and the last 12 hours are proof. But it is in this chaos that the biggest opportunities appear. Keep a cool head, stick to disciplined dollar cost averaging into quality assets like BTC, ETH, and SOL as I've shared. Don't let the panic crowd steal the position you've worked so hard to build. Ask yourself, do you want to be the seller in panic today or the calm buyer becoming the strong hand of tomorrow? Thank you for watching this deep dive analysis. Don't forget to like, subscribe, and hit the bell for updates from Morgan's Money Insights. We are on a bumpy road, but the destination is still the moon. See you in the next video.